In this video, you'll master the MACD indicator and discover strategies to level up your trading game. Here's what you'll learn in this video. The first strategy: smart money strategy. You'll discover how to combine the MACD with institutional trading concepts to find high probability trades. Reversal strategy. You'll learn how to spot trend reversals with precision and use the MACD to time your entries. And finally, trend following strategy. You'll master how to ride the trend confidently by using the MACD to confirm momentum shifts. If you enjoy this kind of content, don't forget to like the video, subscribe to the channel, and hit the notification bell to stay updated with future uploads. And as a bonus, I've got a free trading ebook for you. Check the link in the description below to download it. Let's get started. MACD stands for Moving Average Convergence Divergence, and it's a powerful tool used to identify trends and momentum in price movements. The MACD indicator consists of three main components: the MACD line, the signal line, and the histogram. And all of these components revolve around the zero line, which acts as the center of the MACD. Let's break them down one by one, starting with the MACD line. The MACD line is calculated by subtracting the 26-period exponential moving average from the 12-period exponential moving average. When the 12-period exponential moving average is above the 26-period exponential moving average, the MACD line is above the zero line, signaling positive momentum. Conversely, when the 12-period exponential moving average falls below the 26-period exponential moving average, the MACD line moves below the zero line, signaling negative momentum. Next, we have the signal line. The signal line is a 9-period exponential moving average of the MACD line. It helps generate buy and sell signals through crossovers with the MACD line. Lastly, there's the histogram. The histogram represents the difference between the MACD line and the signal line. When the MACD line is above the signal line, the histogram displays green bars above the zero line, indicating upward momentum. When the MACD line is below the signal line, it shows red bars below the zero line, signaling downward momentum. The zero line serves as the baseline for these components, helping traders visualize whether the market is in a bullish or bearish phase. To summarize, the MACD indicator consists of the MACD line, the signal line, and the histogram, all working together around the zero line to give you insights into market trends and momentum. Now, let's talk about a common mistake that many beginners make when using the MACD indicator, relying solely on MACD and signal line crossovers as buy and sell signals. You might have seen this before. A buy signal when the MACD line crosses above the signal line. A sell signal when the MACD line crosses below the signal line. This strategy can indeed provide good opportunities, but only when the market is trending. Let me show you a chart example. In this uptrend, notice how the MACD line crosses above the signal line. This crossover signaled a great buy opportunity, and the price moved up beautifully afterward. Similarly, in this downtrend, the MACD line crosses below the signal line. This crossover gave a strong sell signal, and the price dropped significantly. This method might seem foolproof, but here's the problem. It only works reliably in a trending market. If the market isn't trending and instead is range-bound, things get tricky. Let's look at another chart example, this time in a sideways market, also known as a range-bound market. Notice how the MACD and signal line cross over multiple times. These crossovers generate what seem to be buy and sell signals, but the price doesn't trend up or down significantly. Instead, it keeps oscillating in a narrow range. What happens here? These crossovers produce false signals. You might enter a trade thinking you've got a clear buy or sell signal, only to see the price reverse on you, again and again. Relying on this strategy in a range-bound market can lead to multiple losing trades. These false signals can quickly add up, potentially wiping out your trading account if you're not careful. Now, let's move on to our advanced strategies. In this part of the video, we're going to explore a powerful strategy that combines the MACD indicator with smart money concepts, specifically focusing on liquidity sweeps. A liquidity sweep is a sudden price move designed to grab liquidity before reversing sharply in the opposite direction. This tactic exploits common areas where retail traders place stop-loss orders and breakout entries. Let's break it down with two classic scenarios. The first is a liquidity sweep with equal highs. The price pushes up toward equal highs, an area where buy-side liquidity accumulates. These equal highs tempt traders to enter short positions, expecting a reversal, while others place buy stops above the highs, anticipating a breakout. The price breaks above those highs, luring traders into long positions, thinking the breakout is genuine. But then, the price reverses sharply downward, triggering stop losses and trapping long traders. The second is a liquidity sweep with equal lows. The price pushes down toward equal lows, a zone where sell-side liquidity gathers. Traders who expect the price to rise often place sell stops below these lows to protect their positions. The price breaks below those equal lows, triggering these sell stops and luring other traders into short positions. Then, the price suddenly reverses upward, hitting stop losses for short traders and trapping them. These liquidity sweeps are classic tactics used by smart money, large financial institutions, to trap retail traders and grab liquidity before making their real move. If you don't understand these sweeps, you can get caught repeatedly, no matter which indicator you use. But here's the good news. By identifying these equal highs and equal lows, you can anticipate liquidity sweeps and trade alongside smart money, not against them. Now, let's combine liquidity sweeps with MACD crossover signals to build a strategy that helps you avoid these traps and find high-probability trades. Take a look at this chart. We have a clear support level where the price has bounced previously. This time, the market reaches the support level again and breaks below it, tempting traders to believe a breakout to the downside is happening. But then, the price closes back above the support level. This is a classic liquidity sweep. Smart money pushed the price below support to trap breakout traders who expected the market to keep falling. Their sell orders get triggered, and their stop-loss orders are hit as the price reverses upward. Now, let's check the MACD indicator. Notice how the MACD line crosses above the signal line. This crossover is a buy signal. This MACD crossover worked because it was aligned with a liquidity sweep. We're not blindly following buy signals, we're first identifying what's really happening in the market. The MACD indicator is acting as a confirmation for our smart money trade setup. And look at the result. The market moves up exactly as anticipated. Now, let's explore another example. Here we have a clear resistance level where the price has reversed previously. The market approaches this level again, breaks above it, and then closes back below. This is another liquidity sweep. Smart money triggered the stop-loss orders of traders who were expecting the price to reverse from resistance. They pushed the price up to hit those orders, and then reversed sharply downward, trapping breakout traders. Next, look at the MACD indicator. The MACD line crosses below the signal line, giving us a sell signal. We're not just trading every MACD crossover we see. We're combining MACD signals with a deep understanding of smart money tactics like liquidity sweeps. This strategy allows us to filter out low-probability trades and only take signals that align with institutional moves. The market moves down in our favor, confirming the effectiveness of this approach. Even when combining liquidity sweeps with MACD crossovers, the strategy isn't perfect on its own. To stack the odds in your favor, you need to incorporate top-down analysis. Here's the golden rule. For trades on the 5 or 15-minute chart, check the hourly chart for the broader trend. For trades on the hourly chart, refer to the daily chart. For trades on the 4-hour chart, look at the weekly chart. For trades on the daily chart, analyze the monthly chart. This simple process ensures you're trading in line with the bigger picture and helps you avoid setups that clash with higher time frame trends. When you align a liquidity sweep, a MACD crossover, and a higher time frame trend, you're trading with precision and confidence, just like the pros. Let's walk through a complete trade example to see how we can combine a MACD crossover signal, a liquidity sweep, and top-down analysis for a high probability setup. Take a look at this Euro/US dollar 5-minute chart. The market reaches a level and reverses, creating a clear resistance zone. The price hits this level again and reverses, confirming the strength of this resistance. Now the market approaches the level once more, breaks above it, and then reverses sharply downward to close below the resistance. This is a classic liquidity sweep. Smart money trapped breakout traders who thought the market would continue upward. Instead, the market reversed, hitting their stop losses. Now that we know smart money has likely trapped retail traders and the market is primed to go down, let's check the MACD indicator. The MACD line crosses below the signal line, generating a sell signal. At this point, we have two key confirmations: a liquidity sweep indicating a bearish move, a MACD crossover supporting the sell idea. But we're not done yet. We need to make sure the higher time frame aligns with this trade. Since we're trading the 5-minute chart, we'll look at the hourly chart to get the bigger picture. On the hourly chart, the market is range-bound, and this key resistance level has been strongly rejected 3 times. After the third rejection, there's a bearish candle indicating downward momentum. This tells us that on the hourly time frame, the market is likely to move down toward the support level. This aligns perfectly with our setup on the 5-minute chart. Now that we have alignment between the 5-minute and hourly charts, it's time to execute the trade. Place a sell order at the close of the bearish candle following the liquidity sweep. Set your stop loss a little above the resistance level to account for potential price fluctuations. Aim for the next support level with a 2-to-1 reward to risk ratio. The market did exactly what we anticipated. It dropped to our target, giving us a successful trade. Let's break down another powerful trade setup, step by step, using our proven strategy of combining liquidity sweeps, MACD crossovers, and top-down analysis. Looking at this Canadian dollar, Swiss franc 5-minute chart, here's what we see. The market hits a level and reverses, forming a key support zone. The price returns to this support level, breaks below it, and then reverses back up, closing above the support. This is a classic liquidity sweep. Smart money manipulated the price to break below support, trapping retail traders who thought a breakdown was happening. Their sell orders get triggered, and their stop losses get hit as the market reverses upward. This sweep signals that smart money has likely finished grabbing liquidity and the market is ready to move up. Now, let's check the MACD indicator. The MACD line crosses above the signal line, giving us a buy signal. We now have 2 confirmations: a liquidity sweep indicating a bullish reversal, a MACD crossover supporting a buy setup. But before we enter the trade, let's make sure the higher time frame agrees with our idea. Since we're trading the 5-minute chart, we move up to the hourly chart to see the bigger picture. Here's what the hourly chart tells us. There was a liquidity sweep on this time frame as well, which preceded a strong bullish move. This move is confirmed by a strong green candle, showing clear bullish momentum. The market is likely to continue up to the next resistance level. The higher time frame supports our bullish idea on the 5-minute chart. Now we're ready to execute the trade. Here's how to set up this trade. Place a buy order at the close of the bullish candle after the liquidity sweep. Set your stop loss just below the support level to protect against unexpected fluctuations. Aim for the next resistance level with a 2-to-1 reward to risk ratio. And look at what happened next. The market moved exactly as anticipated, hitting our target. In this second strategy, we're going to combine trendline breakouts with MACD crossover signals to spot potential reversals in the market. This combination helps you identify when a trend is about to shift direction and gives you the confidence to act on it. When trading with trend lines, there are 2 primary patterns you need to know. A continuation pattern. This occurs when the price touches the trend line and bounces back in the direction of the existing trend, signaling that the trend is likely to continue. A breakout pattern. This happens when the price breaks through the trend line, suggesting a potential trend reversal or a significant change in market direction. In this strategy, we'll focus specifically on breakout patterns and use the MACD crossover to confirm these trade setups. One of the biggest challenges traders face is knowing how to draw trend lines correctly. Should you connect the wicks, the candle closes, or the candle bodies? Draw trend lines in a way that captures the most touch points. The more touch points a trend line has, the more valid and reliable it becomes. Let's break this down for both uptrends and downtrends. In an uptrend, the market forms higher highs and higher lows. Here's how to draw a trend line. Identify the uptrend. Spot a series of higher highs and higher lows. Draw the trend line. Place the trend line below the price and connect as many touch points as possible. Adjust the line to align smoothly with the overall price action. Some candles may slightly overlap or miss the trend line. That's fine. The trend line represents a zone, not an exact level. In a downtrend, the market forms lower highs and lower lows. Here's how to draw a trend line. Identify the downtrend. Spot a series of lower highs and lower lows. Place the trend line above the price and connect as many touch points as possible. Adjust the line so it captures the overall flow of price action. Don't stress about making it perfect. The goal is to draw a line that reflects the market structure. Now that you know how to identify and draw trend lines, let's move on to a trading strategy that combines trendline breakouts, MACD crossovers, and top-down analysis for high-probability trades. Take a look at this chart. We have a clearly defined downtrend with a trend line connecting the highs. Sellers are in control, pushing prices lower. But what happens next? The market breaks above the trend line. This breakout is our first signal that a trend reversal could be on the horizon. The sellers are losing strength, and buyers are stepping in. Now, let's check the MACD indicator. Look closely. The MACD line crosses above the signal line, giving us a bullish crossover. This is a crucial buy signal. In fact, the MACD crossover predicted the breakout before it even happened. This early confirmation adds significant confidence to our setup. We now have two strong signals: a trendline breakout upwards, a bullish MACD crossover. To stack the odds further in our favor, let's perform a quick top-down analysis. We're trading on the 5-minute time frame, so let's check the hourly time frame for confirmation. On the hourly chart, we can see the market was previously in a downtrend. But notice this. The market hit a key level and reversed, creating a demand zone. As the price approaches this zone again, it gets rejected, a sign that buyers are defending this area, suggesting the market is likely to move higher toward the resistance level. This higher time frame bullish momentum aligns perfectly with our 5-minute buy signals. Armed with our signals, here's how to execute the trade. Enter at the close of the breakout candle on the 5-minute chart. Place your stop loss just below the breakout candle. Aim for the next resistance level, maintaining at least a 2-to-1 reward to risk ratio. Let's look at another chart example. This time, we're analyzing the Australian dollar, US dollar on a 5-minute time frame. On this chart, you can see a clear uptrending trend line. This trend line indicates that buyers have been in control, steadily pushing the price higher. However, what happens next? The market breaks below the trend line. This breakout signals that sellers are taking over, and the market may be preparing for a downward move. Next, let's check the MACD indicator. Notice that the MACD line crosses below the signal line, giving us a bearish crossover. This crossover acts as a confirmation of the trend line breakout, signaling that momentum is now favoring the sellers. At this point, we have two critical signals for a potential sell trade: a trend line breakout downwards, a bearish MACD crossover. To strengthen our trade idea, let's perform top-down analysis by moving to the hourly time frame. On the hourly chart, we can see that the market had been trending up. However, it encountered a supply zone and got rejected. This rejection suggests that the market is likely to move downward, potentially heading toward the next support level. This higher time frame bearish outlook supports our sell signal on the 5-minute chart. Here's how we execute the trade. Place the trade at the close of the breakout candle on the 5-minute chart. Set your stop loss just above the trend line to protect against invalidation. Aim for the next significant support level, ensuring at least a 2-to-1 reward to risk ratio. Now, let's dive into our third trading strategy. This one is all about catching breakouts with confidence and avoiding those tricky false breakouts. Look at this chart example. The market was ranging sideways, and then a breakout happened, and the price surged upward. If you can spot these breakouts early, you'll find trades with small risk and huge reward potential. But what happens when things go wrong? Check out this other chart example. Here we have a clear resistance level. You spot the breakout, get excited, place your entry, stop loss, and target. The market moves slightly in your favor, but then reverses sharply in the opposite direction. That's a false breakout. False breakouts are one of the biggest challenges traders face. How can you know if a breakout is real or just a trap? This strategy solves that problem. To avoid false breakouts, our strategy uses 3 key elements: key level breakout, MACD crossover confirmation, and top-down analysis. Let's break it down step by step. First, look for a significant support or resistance level areas where the price has bounced off multiple times. In this example, we have a clear resistance level that the price has struggled to break above. Wait for the breakout. When the price finally breaks above the resistance or below the support, that's your first signal. Now, we need to confirm that the breakout has momentum behind it. This is where the MACD indicator comes in. For a bullish breakout, look for the MACD line to cross above the signal line. This crossover confirms that buying momentum is strong and supports the breakout. In this example, the MACD line crossed above the signal line, giving us a buy signal. This adds confidence to our breakout trade. To further increase your odds of success, use top-down analysis. If you're trading on the 5-minute chart, switch to the hourly chart to check the broader trend. If the higher time frame shows bullish momentum or an uptrend, it supports your breakout trade idea. In our example, the hourly chart shows that the market has broken through a resistance level with strong momentum. It now has room to move up toward the next resistance level on this time frame. This means we have space to trade on the lower time frame and capture a profitable move. Now let's return to the 5-minute chart. The resistance level identified on the hourly chart acts as our target since the market is likely to reverse when it reaches this zone. Here's the trade setup. Enter at the close of the breakout candle. Place your stop loss just below the breakout candle. Set your target at the hourly resistance level. Look at what happened next. The market surged to our target, delivering a 3-to-1 reward to risk ratio. Let's analyze another chart example. This time we're looking at the Australian dollar, US dollar on the hourly chart. On this chart, you can see that the market was rejected 3 times from a key support level. The third time, however, the support level was finally broken. This signals that sellers have gained control, and the market may be ready to move lower. Now let's check the MACD indicator. Notice how the MACD line crosses below the signal line, generating a sell signal. This crossover confirms the breakout and adds confidence to our trade setup. We now have 2 strong signals for a potential sell trade. First, a key support level break. Second, a bearish MACD crossover. Let's move to the daily chart to see if the higher time frame supports our trade idea on the hourly chart. On the daily chart, we can see the market has also broken a key support level, suggesting that the overall trend is bearish. This higher time frame breakdown supports our sell setup on the hourly chart, increasing our confidence in the trade. Now that we have confirmation from both the MACD and the higher time frame, here's the trade setup. Place the trade at the close of the breakout candle on the hourly chart. Set your stop loss just above the broken support level, which now acts as resistance. And aim for the next significant support level, giving us a 2.5-to-1 reward to risk ratio. Watch what happened next. The market hit our target perfectly, just as expected. If you enjoyed the content, don't forget to like and subscribe to the channel for more trading strategies and tips. Hit the notification bell so you never miss an upload. If you found this helpful, let me know in the comments. I'd love to hear your thoughts and answer any questions you have. And as a bonus, don't forget to grab your free trading ebook. The link is in the description section below. Happy trading, and I'll see you in the next video.